What if I told you that most traders who lose money are missing just 5 simple financial ratios? These numbers are the invisible line between consistent profits and costly mistakes. In this video, I'll break down the 5 essential ratios every trader must know to manage risk and build real, sustainable profitability. Stick around. Mastering these could transform your entire approach to trading. Let's start with the risk-reward ratio. It's a fundamental concept, but often overlooked by novice traders. Understanding it can be the difference between consistent profitability and a frustrating cycle of losses. It's arguably the most important number in trading, a cornerstone of sound trading strategy. This ratio tells you how much you stand to gain on a particular trade, the potential upside if your prediction is correct. It quantifies the reward you're aiming for, versus how much you're willing to lose on each trade. This is your defined risk, the amount you're prepared to part with if the trade goes against you. For example, if you risk $100 to make $300, your risk reward is 3. This means for every dollar you risk, you're aiming to gain 3. That means you only need to be right about 25% of the time to break even. Think about that for a moment. Even with a relatively low win rate, you can still be profitable if your risk reward is favorable. Most losing traders ignore this crucial aspect of trading, risking more than they stand to gain, and end up in a losing spiral. They might win a few trades, but the losses eventually outweigh the gains, leading to a depleted account. The key, always define your stop loss and take profit levels before entering a trade. These levels are your predetermined exit points, defining both your maximum potential loss and your target profit. Don't guess. Know your exit points for both wins and losses. This removes emotion from the equation and ensures you stick to your plan. Visualize your entry, stop loss, and take profit on your chart before you trade. This visual representation helps you assess the risk-reward ratio at a glance. A good risk-reward ratio, like 1, 2, or 1, 3, gives you a buffer for inevitable losses. Trading involves uncertainty, and losses are part of the game. A favorable risk-reward ratio cushions the impact of those losses. The higher your reward compared to your risk, the lower your required win rate for profitability. You don't need to win every trade to be successful, you just need your wins to be bigger than your losses. This ratio works hand in hand with your win rate, which we'll cover next. They are two sides of the same coin, both essential for long-term trading success. Remember, a single bad risk-reward decision can wipe out weeks of progress. One impulsive trade where you risk too much for too little potential gain can undo the hard work of many successful trades. Make it a habit to check your risk-reward before every trade. Treat it like a pre-flight checklist, ensuring all parameters are within acceptable limits. Don't let emotions override your plan. Stick to your numbers. Fear and greed can cloud your judgment, leading you to make irrational decisions. Most trading platforms let you plot your risk and reward visually. Use this feature. Take advantage of the tools available to you to make informed trading decisions. This simple discipline can save you from catastrophic losses. It's a fundamental risk management technique that protects your capital and allows you to stay in the game for the long haul. If you only remember one thing, let it be this: never enter a trade without knowing your risk reward. It's a non-negotiable rule for any serious trader. It's your first and best line of defense against unnecessary losses. Master this, and you're already ahead of most traders. It's a skill that separates the consistently profitable from the struggling masses. Don't chase trades with poor risk reward, no matter how tempting they may seem. There will always be another opportunity. Consistency here is what separates pros from amateurs. Professional traders understand the importance of risk management and adhere to their plan, while amateurs often let emotions dictate their decisions. Make risk-reward your trading mantra, internalize it, repeat it, and let it guide your trading decisions. Let's move on to the next crucial number, your win rate, and how it interacts with your risk-reward ratio to determine your overall profitability. Win rate is the percentage of your trades that close profitably. It's a fundamental metric that every trader should understand and track diligently. Think of it as your batting average in the market. It sounds simple on the surface, but it's only truly meaningful when considered in combination with your risk-reward ratio. A high win rate alone doesn't guarantee profitability. You absolutely don't need to win every single trade to be successful. You just need to win enough to make your risk-reward strategy work effectively over the long term. It's about the overall picture, not individual trades. For example, let's say you're employing a strategy with a 1:3 risk-reward ratio, meaning you're risking 1 unit to potentially gain 3. In this scenario, you can actually be wrong a staggering 75% of the time, and still end up making money overall. This highlights the power of a favorable risk-reward profile. Therefore, don't obsess over being right on every single trade. It's a common pitfall for many new traders. Instead, focus your energy on being consistently profitable over time. That's the ultimate goal. While high win rates can certainly feel good and boost your confidence, it's crucial to remember that if your losses are significantly bigger than your wins, you'll inevitably lose money in the long run, regardless of how often you're right. Therefore, track your win rate meticulously and consistently. It's a vital piece of the puzzle. Make it a habit to use a dedicated trading journal or a well-organized spreadsheet to record your trades. For each and every trade, diligently record whether it resulted in a win or a loss. Then, at regular intervals, calculate your overall win rate to monitor your performance. Use this valuable data to spot recurring patterns in your trading behavior and results. Ask yourself, are you consistently more successful at certain times of the day or week? Do particular chart setups or technical indicators seem to yield better results for you? Or are you finding more success trading in specific markets or with certain instruments? Based on these insights, adjust your trading strategy accordingly to capitalize on what's working and minimize what isn't. Don't rely on gut feelings or hunches, know your numbers inside and out. Remember, a seemingly low win rate isn't always necessarily a bad thing. It can be perfectly acceptable and even profitable if your winning trades are significantly larger than your losing trades. In fact, some trading strategies are specifically designed to have lower win rates but aim for much higher reward-to-risk ratios. Ultimately, it's about finding a balance between win rate and risk-reward that aligns with your individual trading style, risk tolerance, and psychological makeup. Always remember that trading is fundamentally a numbers game, not an ego contest or a battle of wits. Keep your focus squarely on the underlying math and probabilities, and try to minimize the influence of your emotions. Use your meticulously tracked win rate as a valuable tool to continuously refine your trading approach. But don't fall into the trap of chasing an unattainable level of perfection. Consistency in your trading and honest, accurate tracking of your results are absolutely key to long-term success. Don't allow a temporary string of losses to unduly shake your confidence or cause you to deviate from your plan, especially if your overall trading system is fundamentally sound and based on solid principles. Regularly review your trading results, adapt your strategy as needed based on the data, and commit to continuously learning and improving. Think of your win rate as a valuable feedback tool that provides insights into your trading performance. Use it wisely to identify areas for improvement and ultimately become a better, more profitable trader. Next, let's shift our focus and take a look at another crucial big-picture metric that every trader should be aware of: your profit factor, which we'll delve into in the next section. Profit factor measures how much you make for every dollar you lose. It's calculated as total profits from winning trades divided by total losses from losing trades. A profit factor above 1 means you're profitable. Above 1.5 is good, and above 2 is excellent. This ratio combines your win rate and risk-reward into one powerful number. It shows if your trading system is truly robust. If your profit factor is low, look for ways to let winners run longer or cut losses faster. Overtrading and inconsistent risk can drag this number down. Track your profit factor monthly or quarterly to spot trends. Use it to evaluate if your strategy is working over time. A high profit factor means your edge is real, not just luck. Focus on both increasing your gross profits and reducing your gross losses. Don't ignore this metric. It's a favorite of professional traders for a reason. If your profit factor drops, review your trades and adjust. Aim for steady improvement, not perfection. Now let's talk about the power of consistent position sizing. Position sizing is about how much you risk on each trade, usually a fixed percentage of your account. Consistency here is critical. Don't let emotions dictate your trade size. Risking 1 to 2% of your capital per trade protects you from devastating losses. One oversized loss can erase weeks of gains. Calculate your trade size based on your stop loss and risk percentage before every trade. This discipline keeps your system's math working as intended. Avoid the temptation to go big on a hunch or after a losing streak. Consistent sizing reduces stress and helps you stick to your plan. It's the foundation of long-term survival in trading. Use a position sizing calculator or spreadsheet to automate this process. Don't let a single trade ruin your account. Make position sizing a non-negotiable rule. With this in place, you're ready to handle the inevitable drawdowns. Maximum drawdown. The term itself might sound intimidating, but understanding it is crucial for any trader or investor. It represents the biggest drop your account experiences. Think of it as the deepest valley you encounter on your trading journey. It's measured from a peak, that highest point your account has reached, to a trough, the subsequent lowest point, before a new peak is achieved. This metric provides a clear picture of the potential downside risk associated with your trading strategy. It's a reality check, a stark reminder of how much you can potentially lose before you're able to recover and start generating profits again. Ignoring this metric can lead to significant emotional and financial distress. Large drawdowns don't just impact your account balance, they test your discipline, your emotional resilience, and the robustness of your trading strategy. They force you to confront your fears and question your approach. Calculate it as the largest percentage drop. This allows you to compare drawdowns across different accounts and time periods, providing a standardized measure of risk. Specifically, it's the percentage decline from a high point in your account to the lowest point before your account manages to establish a new high. If your drawdown is too deep, if it exceeds a certain threshold, recovery becomes exponentially harder, requiring increasingly larger gains just to break even. The deeper the hole, the steeper the climb back to profitability. Know your personal risk tolerance. Understand your comfort level with potential losses. Ask yourself, what's the most you can lose without panicking, without making irrational decisions that could further damage your account? Set a maximum drawdown limit for yourself, a predefined threshold that, if breached, triggers a specific action. If you hit it, pause and reassess your strategy, your risk parameters, and your overall market outlook. Don't just keep trading blindly. Use all the previous ratios, the tools and metrics we've discussed in earlier chapters. Risk reward, win rate, the percentage of your trades that are profitable, profit factor, a measure of your overall profitability, and position sizing, how much capital you allocate to each trade, to keep drawdowns manageable, to prevent them from spiraling out of control and jeopardizing your trading capital. Diversify your strategies, explore different trading styles and asset classes, to smooth out equity swings, to reduce the volatility of your portfolio and create a more stable growth trajectory. Don't ignore drawdowns. Don't pretend they're not happening or that they'll magically disappear. They're inevitable. They're a natural part of the trading cycle, a reflection of market volatility and the inherent uncertainty of financial markets. But they don't have to be fatal. They don't have to wipe out your account and force you to abandon your trading dreams. Prepare mentally and financially for downturns. Build a financial cushion to absorb potential losses, and cultivate a mindset of resilience and adaptability. Review your drawdown history regularly, analyze past performance during periods of losses, to spot warning signs, to identify patterns and indicators that might signal an impending drawdown. If you're uncomfortable with your drawdown, if it's causing you excessive stress or anxiety, adjust your risk or strategy. Reduce your position sizes, tighten your stop-loss orders, or explore alternative trading approaches. The goal is to survive and thrive over the long term. It's not about avoiding losses altogether, but about managing them effectively and consistently. Drawdown management is what keeps you in the game, what allows you to weather the inevitable storms and continue pursuing your financial goals. Don't let a bad streak knock you out. Don't let a series of losses discourage you from continuing your trading journey. Stay disciplined, adhere to your trading plan, and maintain a long-term perspective. And you'll weather the storms, you'll navigate the turbulent waters of the market, and you'll emerge stronger and more resilient. Let's wrap up with your blueprint for trading success. These 5 ratios, risk-reward, win rate, profit factor, position sizing, and maximum drawdown, are the backbone of profitable trading. They turn guesswork into a repeatable, data-driven process. Review them regularly, and let them guide your decisions. If you found this valuable, hit like and subscribe for more trading insights. Which ratio will you focus on first? Let me know in the comments. Remember, trading is a marathon, not a sprint. Use these numbers as your map and compass. Stay disciplined, keep learning, and I'll see you in the next video.